please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Live from Hong Kong, this is Squawk Box.
Hour 2 of Tuesday Squawk Box begins right now. It is top of the hour, 8 a.m. here in Hong Kong and in Singapore, where in the time zone we're in. Here are your headlines, get you going. Crude oil hitting 2-year highs on rising tension in the Mideast. The Saudis say Hezbollah aggression amounts to a declaration of war by Lebanon. 10 cents China Literature pricing its IPO here in Hong Kong at the top end, raising more than $1 billion in the process. The stock debuts tomorrow. And our coverage of President Trump's Asian tour continues as he heads to South Korea today after a summit with Prime Minister Abe of Japan. We've got coverage wall to wall at Kiko in Tokyo, Sherry in South Korea. Good morning, ladies.
Good morning to you, Bernie. That's right. We are in Tokyo, where we saw the Abe-Trump bromance on full display, but some tension between these two leaders on the issue of the U.S. trade deficit with Japan. President Trump saying trade needs to be fair and reciprocal.
And President Trump tweeting about massive military and energy orders coming from Japan. Is that what he has in mind in South Korea? His touchdown for a state visit in South Korea expected in over 3 hours.
Meantime, the lead we got from Wall Street was 3 indexes that keep edging up, fresh territory. We marked new highs in all 3 markets. We're not getting an exact follow-through in these parts, but it's early goings. We're down about 20 points with the Nikkei 225. Topics is also going south, and the Kospi has just edged down a little bit. ASX 200, though, is up 38 points on what is Melbourne Cup Day in Australia. All right, elsewhere. NYMEX crude eased a touch in Asian trade after hitting 2-year highs overnight on the back of that growing tension in the Gulf. Security issues also at the forefront for Egypt as President El-Sisi marks nearly a full term in office, but critics say government's tactics have been draconian and opponents have been targeted. Speaking exclusively to our own Hadley Gamble, Sisi says security forces have been careful about collateral damage and the situation is far more stable since he came to power.
Of course, if there was any criticism on the security situation, we are at war against terrorism in the full meaning of the word. Egypt is in this war alone without duplicity. We are serious and honest in confronting terrorism. Another point, when we are confronting this terrorism, we are very keen that no innocent people or civilians are hurt. The fight is not easy. We are protective of the people who have nothing to do with this war. Stability has been achieved by comparison to what it was like before. No, of course, the level of stability has increased in a very big and noticeable way. I'm not the only one saying this, but everyone who is following Egypt's affairs can see this. But have we resolved the situation? Of course not. You know well that the American forces are in Afghanistan and Iraq, and despite all the efforts, terror has continued for many years. Absolute decisiveness with terrorism is not easy.
Is the U.S. fulfilling its commitment to Egypt when it comes to providing equipment and intelligence in helping combat the threat of terror?
It has completely changed for the better since President Trump has come to power in the United States.
Drama in the Mideast escalating after the Saudis accused Lebanon of declaring war against them. Shri, this took a turn for the worst over the weekend when the Saudi-backed Prime Minister, the Premier Saad al-Hariri, resigned, saying that he feared for his life. And look at where we are now. Wow.
Yeah, and it really just underlines this disturbing momentum in terms of the proxy wars that Saudi and Iran have been fighting in the region. So it does point towards destabilization. But I just want to pick up on the alliances between Washington and Riyadh, because I think that is an important dynamic as well. It's very clear here that the White House is offering its full support to Riyadh, whether it's on the anti-corruption drive or whether it's on this proxy war that Saudi has been fighting with Iran. And whether the end goal here is to try to win the the IPO business and get Aramco listed in the NYSE is anyone's guess. But President Trump, in a tweet, has said that he has great confidence in King Salman and in the Crown Prince. They know exactly what they're doing. Those arrested, he says, have been milking their country for years. And then the Pentagon has been backing Saudi foreign policy, effectively accusing Iran of arming and supporting the Houthi militias in Yemen. So it's these proxy wars in the region, Bernie, between Saudi and Iran that are taking on, arguably, a new disturbing momentum. And the danger here, for Saudi at least, is that it is opening multiple fronts, multiple new fronts as well, when you consider Qatar, Iran, Lebanon, and internally as well in terms of the anti-corruption drive and the seeds of political unrest, arguably, it may be sowing. In terms of foreign policy, and the oil market is watching this very, very closely, there's increased confrontation risk with Iran. That is the common denominator. And Bernie, whether it's the missile attack that you referred to on Saturday that was intercepted from Yemeni territory, it was a missile attack that targeted the King Khalid International Airport on the northern outskirts of Riyadh, or whether it's this belief in Riyadh that Lebanon has declared war against the kingdom for failing to control Hezbollah. The hand of Iran is at work here. That is what the Saudis believe. The oil market is watching this, and remember, the backdrop here is looking tighter, whether it's supply disruptions coming out from northern Iraq or whether it's sanctions-related potential supply disruptions from Venezuela and Iran. I think this is a market that's far more sensitized than it has been before to potential disruptions, oil supply disruptions, and the geopolitics of this region.
Yeah, absolutely. The friction has certainly snowballed in a very short span of time. Sri, let's talk to Ian Hartnett, the co-founder and chief investment strategist at economic and macro strategy research firm Absolute Strategy Research. Joins us here in Hong Kong today. Ian, welcome to the show. Good to see you in Hong Kong. Again, this stuff, you know, when we booked you, this stuff in the Mideast hadn't even erupted.
Well, that's the great thing about markets, isn't it? but you know, what we've had is we've had a period of low volatility in things like oil prices. The excess liquidity has allowed even the North Korean crisis to just wash over the market. Now we're going to get, I think, much more of a test of whether these markets really are robust. And we think you should be selling into this type of environment rather than buying into it.
Really? Selling into it? I mean, when risk goes up, isn't that when you want to latch on for the ride?
Well, I think the trouble is that, you know, we've got markets which are already close to 20 times trailing multiples. You know, you've got liquidity being taken out of the market by the Fed and the ECB, and yet you've got this increase coming through in the oil price as well. You know, that's an environment where normally equity risk premium would go up, equity markets go down, and bond yields get some support. So, you know, I think that, you know, certainly, you know, we would actually be thinking this is more of a risk-off environment, and people should be getting quite nervous, I think, because you're interrupting trade. You're seeing President Trump talk about interrupting trade potentially, and you're now seeing things like the Middle Eastern situation, which has the capacity to just destabilize global economic
Ian,
activity.
Can I get you to say hi to Sri and
Singapore?
So
Ian,
there you go, gentlemen.
Hi, Ian. Good morning to you. So, do you think that it's a disorderly and stress on the word disorderly rise in the oil price towards 70, possibly even higher, that could really ground this Icarus melt-up that we've been seeing in risk assets?
Yeah, I think so, you know, because if you look at what we've had, you know, the fundamentals, we would say, are still talking about mid-50s for the long run, you know, the 12-month view on the oil price. But what we've seen in these previous episodes where you've had sharp rises in the oil price because of geopolitical events, that tends to destabilize. It tends to favor the US market, ironically, even though that's the expensive one, at the expense of Asian markets, at the expense of European markets to some extent as well. And also Japan tends to hold up reasonably well in this kind of environment when you get a bit more of a risk-off trade coming through.
I know it's still early days, Ian, but clearly this is going to have implications for central bank policy, especially if this move in oil is sustained. It will have a knock-on effect on the inflationary impulses, and central banks like the Fed possibly may have to move faster. Is that where a policy error in terms of pushing these markets lower comes in?
I think that's one of the interesting questions, which is how policymakers respond to this. You know, they've actually been desperate for inflation to go up. Now we might get some of that because of the higher oil prices. But the only question is, you know, if it's a disorderly market in terms of equity markets coming off in response to that, will they start to say, well, actually, this is a tricky environment for us to actually be tightening policy. Let's look through that short-term rise in the inflation rate because of oil, and actually let's pull back from some of that quantitative tightening, some of that tapering that we've already talked about for the markets, because we're worried about those financial conditions indicators that you know that William Dudley particularly has been focusing on in the FOMC, and that is whether they'd actually pull back from tightening too rapidly. So I think it's going to be a fascinating environment. But what you're talking about is heightened uncertainty for markets, and we know that with the VIX so low, you know, that's the thing that could actually really destabilize these markets.
I love your comment about inflation. I've been likening it to a dog chasing the fender on a car. I mean, it's fun while you're doing it, but what do you do with it once you get there, right?
You know, there's different types of, there's good and there's bad inflation, isn't there, Bernard? You know, what we actually want is an inflation that comes through because economic activity is picking up aggressively. We're getting pricing power for the corporate sector, and you're getting those earnings numbers coming through. You know, whilst this might be great for the oil sector's earnings short term, for the rest of the market, actually it's pretty disastrous.
Ian, is there an increasing narrative to lock in whatever yield you can when you're starting to see yields start to go up, rather than pay inflated equity prices to nail down the dividend yield?
Yeah, you know, what we see is that when you look at the relative 3-year changes between equity markets and bond markets, when we get back up to that 260, 270 type area on US Treasury yields, actually equities start to look expensive relative to bonds. And, you know, at that point, we think you'll see this rotation back towards the bond market, you know, until you get stronger economic growth and that better type of underlying inflation coming through. It's pretty difficult. So our view is that China growth is slowing. The US and Europe are withdrawing liquidity. That's going to limit global growth. And this pickup in oil prices is just going to add to that pressure for global growth to actually decelerate into 2018 rather than carry on accelerating. And that's where you get this move back into bonds around about the 250, 270 type area.
There we go. And that's just the sovereigns, because in the corporate you can still get investment grade at 500, 600 basis points.
I think that we'd actually be more worried about some of that investment grade and high yield stuff, because if you actually see the liquidity withdrawn, particularly in the United States, you know, the debt position for the corporate sector, the mid cap and the small caps, may actually be a lot less fragile. All that cash is held by those large companies, and that's where, you know, the Fed's going to be tested in terms of being able to push rates too quickly, too soon in this environment.
Ian, it's always great catching up. A pleasure, okay?
Thank you very much.
Good to see you. All right. Enjoy our autumn here. It doesn't last very long, Ian Ortner.